There is a particular kind of madness that only arrives dressed in a suit. Not the wild-eyed, foaming at the mouth kind. The quiet kind. The kind that sits in a boardroom, nods along to a presentation built on numbers that do not add up, and then writes the check anyway. The dot-com bubble was not a mystery. It was not a black swan event that came screaming out of a clear sky. It was a very loud, very public, very documented implosion that was visible from miles away, and almost nobody in a position to stop it chose to try. Over $5 trillion in market value, gone. Thousands of companies, gone. An entire generation of engineers, investors, and everyday people who believed they had finally figured out how wealth worked, gone. And the most disturbing part of the whole story is not how fast it collapsed. It is how long everyone watched it build in real time, in plain sight, and collectively agreed to look the other way. This is the story of the dot-com bubble. Not just what happened, but why intelligent people let it happen. And what that says about the way human beings behave when money, fear, and momentum are all moving in the same direction at the same time. The setup, a world ready to believe. To understand what happened in the late 1990s, you have to understand what the world felt like in the years just before it. The Cold War was over. The economy was growing. Unemployment was falling. The US government was running a budget surplus for the first time in decades. For the American middle class, the mid-90s felt like the opening credits of something genuinely new. And then the internet arrived. Not the internet as it exists today, fast, invisible, woven into everything. The internet in 1994 was a genuinely strange and alien experience. Dial-up modems that screamed at you. Web pages that took 4 minutes to load a single image. Chat rooms with handles like Dark Knight 1987. It was clunky, confusing, and completely captivating. But underneath all of that friction, a serious idea was forming. What if this thing, this messy, impractical, bizarre digital experiment actually changed everything? What if it changed how people shopped, communicated, read the news, ran businesses, moved money? The answer, we now know, was yes. The internet did change everything. The problem was that in 1996, nobody could agree on the timeline or the business model, and Wall Street decided it did not need either. When Netscape went public in August 1995, it had no profits. It barely had revenue. The company was 16 months old. Its stock was priced at $14 per share. By the end of the first trading day, it closed at nearly $58. That single event rewired the financial imagination of an entire generation. If a browser company with no earnings could be worth hundreds of millions of dollars on day one, what else was possible? The answer, apparently, was anything. The machinery of delusion. What followed was not simply greed. Greed is too simple a word for what the late 90s produced. What followed was a complete restructuring of how intelligent people evaluated the concept of value itself. Traditional investing had always been anchored to fundamentals: earnings, revenue, cash flow, the boring calculus of whether a company actually made money. These were the tools that analysts used, the metrics that institutions trusted, the numbers that pension funds and retirement accounts were built around. The internet startup era did not just challenge those metrics, it openly mocked them. A new vocabulary emerged to replace the old one. Eyeballs instead of customers, page views instead of sales. Burn rate presented not as a warning sign, but as a badge of ambition. The faster a company was spending money it did not have, the more serious it appeared to be about the future. Valuation models that had taken decades to develop were quietly set aside. In their place came something far simpler. The belief that market share captured today would be converted into profit tomorrow, and that whoever got there first would win everything. First mover advantage. two words that justified nearly any financial decision made between 1997 and 2000. Venture capitalists, who had spent careers carefully vetting business models, were now making decisions in 48 hours. Founders who had never run a company of any kind were handed tens of millions of dollars based on a presentation and a domain name. Investment banks were rushing companies to public markets before there was anything to show beyond a promise and a logo designed in Photoshop. And the individual investor, the schoolteacher with a brokerage account, the retiree who had always kept money in index funds, was watching their neighbor's portfolio double and feeling left behind. This is the mechanism that almost nobody talks about when they discuss the dot-com era. It was not just professional investors making poor decisions. It was an entire society's relationship with risk quietly changing, because the cost of not participating felt like it was growing every month. The signs were everywhere. Here is where this story becomes genuinely uncomfortable. Because the warnings were not hidden, they were not buried in regulatory filings or whispered in private rooms. They were loud, documented, and widely circulated, and the market responded to most of them by going higher. Alan Greenspan, then chairman of the Federal Reserve, stood up in December 1996 and asked a simple question: was the stock market being driven by irrational exuberance? Those two words entered the financial lexicon immediately, and the market, after a brief dip of about 2%, resumed climbing as if nothing had been said. Warren Buffett, perhaps the most credible long-term investor alive, declined to buy technology stocks during this period. He said repeatedly and publicly that he did not understand the business models and could not assess the value. The financial press largely treated this as evidence that Buffett had lost his edge, that the old ways of thinking no longer applied, that the new economy had simply passed him by. He was not passed by. He was right. Independent analysts were publishing research throughout 1998 and 1999, pointing out that the valuations being assigned to companies with no path to profitability were not just aggressive. They were, by any conventional measure, impossible to justify. The reports were read, discussed, and largely ignored. Inside the industry, there was a growing awareness that something had gone wrong with the process. Investment bankers privately acknowledged that many of the companies they were bringing to market should not have been anywhere near a public stock exchange. Venture capitalists knew that a significant portion of their portfolio companies would never earn a dollar in profit. Analysts who worked for the same banks underwriting these IPOs were issuing buy recommendations that they had significant private doubts about. Everyone, in other words, had some version of the same quiet thought. And almost nobody said it out loud where it mattered. The psychology of a crowd that cannot stop. Why not? That is the real question at the center of this story. Not what happened to the money, but what happened to the judgment of people who should have known better. The behavioral economics research that has emerged in the decades since offers a few answers. None of them are flattering. The first is something researchers call herding. When a large group of people in a high-stakes environment all appear to be making the same decision, the psychological pressure on any individual to deviate from that decision is enormous. Not because the group is necessarily right, but because being wrong alone carries a cost that being wrong together does not. If you are a fund manager who missed the technology rally of 1998 and 1999, your career is in jeopardy. If every fund manager missed it, the whole industry has a bad year, and everyone moves on. The second is the incentive structure that surrounded the bubble. Investment banks made extraordinary fees underwriting .com IPOs. Analysts who covered technology companies were compensated in ways that tied their financial well-being to the performance of the banks they worked for. Venture capitalists were sitting on paper returns they had never seen before. Everyone who was close to the money had a structural reason to let it keep going, and very few people with the authority to slow it down had any financial interest in doing so. The third is arguably the most human of all. When prices have been rising for long enough, the memory of them doing anything else fades. Not completely, and not for everyone, but enough that the lived, visceral understanding of what a significant loss actually feels like begins to weaken. The 90s bull market had been running since 1982. There were analysts covering technology stocks in 1999 who had never professionally experienced a serious bear market. The concept of a correction existed in textbooks. It did not fully exist in their experience. Taken together, these three forces, social pressure, misaligned incentives, and historical amnesia, produced a collective decision to keep moving, not out of stupidity, out of the entirely rational conclusion, from any individual's perspective, that stopping was more dangerous than continuing. The collapse. The Nasdaq hit its peak on March 10, 2000, 5,048 points. There was no single announcement that turned the tide, no catastrophic event, no institution that failed overnight and sent shockwaves through the system. What happened instead was smaller and, in retrospect, inevitable. Investors who had been sitting on enormous paper gains began cautiously, quietly, individually to sell. And when prices began to fall, they discovered something that rising markets tend to obscure. The companies they owned did not have the cash to survive a prolonged downturn. The business models they had funded would never generate the revenue needed to justify their valuations. The customers they had been promised would arrive in the future had not materialized and were not coming. Confidence, once it started draining, moved quickly. The sell-off that began in March accelerated through the summer and into the autumn. Amazon fell from over $100 per share to $6. Cisco, one of the most valuable companies in the world at the peak, lost nearly 80% of its value. Hundreds of companies simply ceased to exist, not acquired, not restructured, just gone. Offices emptied. Ping-pong tables were hauled to the curb. The cheerful chaos of the startup era gave way to something quieter and much harder. By the time the Nasdaq found a floor in October 2002, it had fallen 78% from its peak. $5 trillion in market value had been erased. More than half of all dot-com companies that had existed at the peak had shut down. The party was over. The cleanup had barely begun. What survived and what it means. Here is what is strange about the aftermath of the dot-com collapse. The core premise that the internet would transform the global economy turned out to be completely correct. The believers were right about the destination. They were just catastrophically wrong about the timeline and the economics of getting there. Amazon spent most of 2001 and 2002 being described in the financial press as a company that was probably going to fail. It did not fail. It became the foundation of modern retail and the backbone of global cloud computing. Google barely existed at the peak of the bubble. It went on to organize the world's information and generate one of the most durable advertising businesses in history. The fiber optic cables buried during the boom investments that helped destroy the companies that installed them became the infrastructure on which the modern internet was built. The internet did change everything. It just needed a decade of failure to figure out how. What the bubble produced, underneath all of the destruction, was a process. An expensive, brutal, often deeply unfair process of selecting which ideas deserved to survive and which did not. Pets.com did not survive. Neither did Webvan, or eToys, or the dozens of other companies that had burned through investor capital, chasing a version of the future that was real in outline but wrong in execution. The companies that made it through shared a few characteristics. They had real customers. They had revenue that was growing in proportion to their costs. They were solving problems that people actually had, not problems that made for good pitch decks. and they were run by people who, when the money stopped flowing, found ways to keep moving without it. These are not complicated criteria. They were, in fact, the same criteria that disciplined investors had been applying for decades before the bubble convinced everyone that they were outdated. The lesson that keeps not being learned. Every generation of investors inherits the warnings of the previous one. The dot-com bubble came with abundant documentation of exactly how it went wrong, who saw it coming, and what it cost the people who were still holding when the music stopped. And yet, the underlying pattern, new technology, transformative narrative, suspension of fundamental analysis, enormous capital inflows, valuations untethered from business reality, has repeated itself with striking regularity in the years since. Different assets, different vocabulary, the same architecture. The lesson is not that transformative technology produces bubbles, though it often does. The lesson is that the belief in transformation does not automatically make every investment in the space of that transformation a good one. A technology can change the world and still be dramatically overvalued at a particular moment in time. Both things are true simultaneously. The dot-com era did not produce a generation of fraudsters, though some fraud occurred at the margins. It produced something more interesting and more dangerous. A generation of true believers who were so convinced of where the future was going that they stopped asking whether the specific thing they were paying for would get them there. The internet was real. The vision was real. The $5 trillion that evaporated was also real. The bubble that everyone saw was not stopped because watching something rise, however irrationally, is, in the short run, far more comfortable than being the person who says it should not be. That discomfort is expensive. It always has been. And the most useful thing any investor can do is learn to feel it clearly, early, and before the bill arrives.